Yo, what's up, everybody? It is Tuesday, January 31st. We made it through January, and the fun is about to begin. Let's talk about today, because today, I think, was a very interesting day. And you know, I tell all of you guys, I've been around for a long time. I've been doing this over 40 years. I was a member of 4 exchanges. I was a floor trader. I was a money manager for a major hedge fund. I was a proprietary trader for a major international bank. So, like, you know, I absorbed a lot of experience over the years. And I have to tell you that, and it doesn't take, I'll tell you this, it doesn't take 40 years of exposure to Wall Street to kind of figure out that today's big rally was based on information leaked by the Fed regarding tomorrow's meeting, or the outcome of the meeting, or the statement, or whatever policy decisions they make. Now, I don't have concrete evidence of that, but I would bet anything, that information was leaked. And so insiders, people who are privy to that, you know, they were buying all day. By the way, just as a side note, the fiscal situation, balances, financial balances are still like 14 billion below where we were on December 14th. So, you know, we briefly made back the December 15th tax drain, and then we were also, you know, in the net positive for January, and then all that was drained out again. So we're still not back at the level of December 14th. So, you know, if you've been listening to my last couple of videos, I said I think the market is overextended based on the fiscal picture right now, and I think it's prone or susceptible to a pullback. And I mean, we had a couple of intraday pullbacks, but you could see the buyers coming right back in. So I would bet anything that the information was leaked about what tomorrow's policy decision is going to be. And we, you know, based on the rally today, it sounds like they're going to say, well, we know they're going to raise by 25 basis points, and they might say we got one more hike coming, or the way we went up today, they might say we're going to do a pause right now. And so this is everything that I've been telling you folks. First of all, let's just understand one thing. The underlying reason for the stock market's recovery since October has been the re-acceleration in the fiscal flows. And I mean, I've charted that out for you. Here's a chart right here. I mean, you could see definitely where the big contraction in fiscal support that happened in the first half of 2022, which I also told you was going to happen, but I didn't say go short, because I still think that net spending is going to be sufficient. You know, we were going to come down, we were going to level out, and then we were going to go back up. And that's exactly, you know, the pattern that has evolved. Exactly what I said. But you could see the re-acceleration in the fiscal, and that, you know, set aside all this monetary bullshit and everything else like that, which, you know, I just call these people zombies, and they're psychotic, and they're manic, and just they're totally emotional. And the worst thing of all is that, I mean, it would almost be halfway justifiable if they even understood their paradigm of monetary policy, but they don't even understand that. But that's a whole separate video. Anyway, so what we'll see tomorrow from today's action is a dovish Fed. I said that we're going to see an increasing amount of short covering or lifting of those bearish bets that have been in place. Look, we got some big names out there. This guy Mike Wilson at Morgan Stanley, okay, the biggest bear. We had the biggest bear at Goldman Sachs last week on Friday saying, and I did a video about this, it just doesn't look like it wants to go down. He's probably making, I don't know, a few $1 million a year. It just doesn't look like it wants to go down. Maybe he went to Harvard. Maybe he went to Princeton. I don't know. You know, Goldman always hires from Ivy League. So, I mean, this is what you're getting, folks. Not here. Not here from me, but this is what you get. Doesn't look like it wants to go down. Oh, thank you, whoever. You know, big shot at Goldman. All right, so we have covering. Now, I've been spelling this out for you, okay? What could be interesting tomorrow, because, by the way, tomorrow also we'll get the first of the month payment, so that would be, you know, we're getting Medicare, we're getting Medicaid, we're getting military pay, we're getting veterans benefits, we're getting disability, you know, all those big government withdrawals that happen on the first of the month. So that's like a 65 billion net positive flow. So that's going to put us finally, you know, back above the December 14th level. I don't know if it's going to put us at the January 12th level, okay, but it's, you know, I mean, I expected this. All of these, by the way, all these things are predictable because they're scheduled in the way the government spends. It's not like, hey, I found out through the grapevine that, you know, they're gonna spend $100 billion tomorrow on Medicare. No, it's like we know when these spendings and when the spending and these tax trains are going to occur. They're in the calendar. They're set. It's automatic. I mean, if you're not using this stuff, then I don't know what to tell you. I mean, they're literally handing to you on a silver platter, you know, $100 billion is going in tomorrow. $80 billion is coming out on, you know, April 15th or whatever. If you're not using this information, then there's no reason really to be on this channel. I mean, you go, you know, do your charts, do your Fed, you know, microscopic analysis, whatever you want to do. It doesn't faze me. It doesn't faze me. So that's good. And I said February will be good leading up to the 15th of February when we're going to get that quarterly interest payment. It's going to be like around 46 billion. February is going to be big. Plus, I said yesterday we're going to have IRS tax refunds starting to go out in February, March, and April. Last year that was like 260 billion of, you know, increased positive flow. The only thing what happened last year is that the monetarists were, you know, they were really triggered because that was the beginning of the Fed rate hikes. And I'm not going to lie, at the beginning of rate hikes, especially when you go from 0, you know, to 50, to 1%, to 175, to 250, you know, there is a discounting effect on financial assets. And I talked about that at length. But I said we were going to hit an inflection point where the discounting, the negative effect from discounting of financial assets will be offset by the positive effect of the increased interest income flows into the economy. And that's exactly what's going on. I mean, the Fed doesn't really understand this because they're saying, oh, we got to keep raising rates even though the economy is strong. You know, they can't connect the dots that the economy is strong because they're pumping in all this free money to the banks, you know, to holders of government securities, etc. So I get back to what I've been saying all along. The only, you know, what was it that FDR said? Like, the only thing we have to fear is fear itself. But I would just tweak that by saying the only thing we have to fear is the debt ceiling. And that's because politically, and I don't know, I think it was scheduled that House Speaker McCarthy was supposed to meet with Biden today, but I saw some of McCarthy's tweets, and again, he's like just comically and ridiculously invoking the analogy of a household, like, hey, you gotta balance your budget at the kitchen table. The government, no, it doesn't work that way. The government is not a household. It's not a state. It's not a corporation. It is the issuer of the currency. There is no constraint on its ability to issue that currency. There might be a constraint of inflation if the real assets are not there to consume. But that's a whole. We had that during the pandemic, and that's a whole separate argument. That's an apples and oranges argument. I mean, but to have this view now, and I've done many rants on this, as you know. To hold on to this view now, and by the way, if you were to ask me, Mike, don't you think that's just political leverage? I would say no. I would say no. I would say that's what they really think. And yeah, they are using it as political leverage, but they're using it as political leverage because that's what they truly believe. They believe like the government's finances are like a household. Hang on. New York, baby. All right. So I think I was about to say, like, I would not be surprised at all if tomorrow we get a quick, let's put it this way, a quick pop up from the Fed meeting, and then everything goes down. Okay? And again, I'm not saying there's going to be a crash or some kind of new leg down in a bear market. I've actually seen people predicting, oh, this is nothing. We're going down another 37%. How they come up with these numbers? 37%. Like not 35, not 40, not 30, no 37. People are wacko, man. They're wacko. But it's always these kind of gold bugs, hard money monetarists who are coming up with these crazy things. So I would let that happen. That would be really cool. I actually bought some ExxonMobil stock today on the opening. It was down and then it rallied real nice. That's what you got to do. I mean, the banks were down. I don't know how they closed, but I mean, they were down for a while. I keep advising buying the banks, checks. Fed is just giving them money, right? And I actually think, I may be a little bit early on this, but I'm going to say it. Tomorrow, if the Fed comes out with like a dovish statement and a policy direction that is construed as dovish, or the slowdown, the pivot, whatever you want to call it for these crazy monetarists, the dollar will go down, but I think you got to buy that. And I actually have I've been short the dollar now for a while. I made very good money. I'm actually a little bit long the dollar right now. And if it dips, because I'm looking at February 15th when these flows are going to peak out, and then I'm looking at March, I'm looking at April, and then I'm looking at June with the debt ceiling, and we can get a very, very nice recovery in the dollar, all right? So basically, I'm trading it. So that's it for today, folks. Tomorrow's going to be very fun and fascinating and funny, and there's going to be a lot of things to talk about. And please, folks, and I forgot to say this at the beginning of my video, which I'm going to start saying this from now on. If you like my videos, please click the like button and subscribe. It really helps with the Google algorithm. And it's not a hardship on your part. I'm asking you to do that. Thank you very much. See you tomorrow. Bye.